couple of weeks ago, after the last Fed meeting, I talked about the source of inflation in the US, and I talked about the Fed outlook for the US economy. I remarked that if we wanted to look at inflation, where inflation came from, it had nothing to do with the Fed, had everything to do with the Biden administration American Rescue Plan of last year, where they added a deficit of 12% of GDP in a situation where the GDP gap, the available resources for growth in the US economy, was only 1.7% of GDP. And that meant that of the 12% of GDP of stimulus in the American Rescue Plan, 10.3% of it went directly to pushing up inflation. So that's where the inflation came from. The fact that spending was vast and the deficit stimulus was vastly larger than the excess resources available in the economy for growth. I then talked about what the Fed was doing or had talked about at that time, but I also wanted to talk today about the information that's come forward in the Fed minutes about quantitative tightening. And quantitative tightening as opposed to quantitative easing. Quantitative easing is when the Federal Reserve is buying US Treasury bonds and buying mortgage-backed securities to push down the yield on those. And quantitative tightening is when they start selling those bonds and mortgage-backed securities, which has the effect of increasing the yields on those. And in the Fed minutes, Jay Powell says, or the Fed minutes reveal that they are selling $60 billion a month of Treasury securities and $35 billion per month of mortgage-backed securities, and that means that there's $720 billion of Treasury securities being sold per annum, which is 2.9% of GDP. I'll come back to that measure relative to GDP again a couple of times. So when we look at mortgage-backed securities, they're selling $420 billion, or 1.7% of GDP. And add those together, and that's 4.6% of GDP. Now, I've done a lot of work on the effect of budget deficits on what they have and the effect in pushing up yields. So the result of that is that if you're running budget deficits without QE, you push up yields by for each percent of GDP, you push up yields by up to 25 basis points for each percent of GDP. You can measure that in different time periods as being a bit less than that. But so what I think actually happens here is that in addition to the tightening that is happening at the short end of the yield curve, in which we expect the Fed funds rate to go up around about 2% this year. In addition, and for that to have an effect on pushing up long-term interest rates, both in terms of US Treasury yields and mortgage-backed securities. In addition to that, there's an additional upward pressure on long-term interest rates generated by the Fed selling bonds and selling mortgage-backed securities. Now, Jay Powell, in his presentation at the time of the Fed meeting, suggested that the effect of that might be 0.25%. I think the effect of those interest rates is around about 3 times that amount, and I think it's about 75 basis points. Now, why that's interesting is that if you look at, for example, mortgage-backed securities, they're already up to 4 percentage points from where they were at the beginning of the year. So even though the Fed funds rate's only gone by 25 basis points, the long end has gone up by 2%. So it's the long end in the US which really drives housing loan interest rates and commercial loan interest rates and really drives its effect on the economy. So what I'm saying here, if you put together a combination of the Fed funds rate going up and these sales of securities from quantitative tightening, you're going to have very significant increases at the long end of the yield curve by the time we get to the end of this year, and that has a significant effect on slowing down the US economy and slowing down demand in the US economy. So when you read commentaries by an Australian and other journalists that the Fed isn't doing enough to tighten monetary policy, or it isn't doing enough to rein in inflation, that's because those people don't know how the US economy works. The Fed is doing plenty by hiking rates and selling mortgage-backed securities and bonds, and that will very adequately slow down the US economy enough and cut inflation to the target within a couple of years. That's the end of my comment. Are there any questions?